Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah. And over the next 25 minutes, we'll discuss about a few key aspects regarding mutual funds. There are some new rules and regulations that have been put out. We're on the cusp of the numbers coming out for the month of September as well in terms of flows. And there are a bunch of other things. So let's talk about all of those with Mr. Balasubramanian. He's the MD and CEO of Birla Sun Life AMC. And they, of course, have an NFO which is on as well. Yes, it is on right now. So it'll be lovely to talk about that too. Bala, good having you. Thanks so much for joining in. Hope all is safe.
Yeah, everything is fine, Neeraj, and thanks for having me part of your mutual fund show after a gap of almost 4 or 5 months now.
Yeah, it's been a while, but it's good having you. So I'm glad we're talking today. Can I start off with what really caught a few people, not by surprise really, but got people thinking? This, for a lack of a better word, this new product labeling that SEBI is asking to do, a riskometer of sorts. And I remember a conversation that we had in your office about 2 years back, wherein you had told me that you anyways do something like this for some of your products. But I'm just wondering, how do you view this? Is it sending out some kind of messaging, and two, what end would it serve?
Yeah, I think one of the focus that has come as part of the regulatory framework in the last, say, 6 or 7 months is wherever there is a need for greater clarity to be provided, whether it is with respect to the product labeling or the way the money managers are managing the funds and what they say and what they do, and both have to be matching, which is called as a walking the talk, true to the label. And we keep looking at these things on a continuous basis. And also the risk is something, you see something, but it happens in reality something. Therefore, how do you manage the risk, and therefore how do you actually communicate those risks as part of the communication to the investors as the initiative towards giving more clarity to the investing public at large, as well as the people who are advising about the mutual fund. I think both the things that you referred, that basically the classification of schemes, this is something I think served a greater purpose when it was introduced about 2.5 years, 3 years back, and I was part of that committee as well at that point of time from the AMC side. And it gave a lot of clarity, and people really liked it. Now I think everybody has got a uniform definition across the mutual fund. And the multi-cap category, they felt probably need to also have a similar kind of thing. That's why I think the regulatory thing came. But having said that, and having also seen the reactions coming from the industries, and they also, of course, were open to listen to the feedback coming from the AMFI as a body, which they have taken on board, and probably they will come back with some kind of clarity with respect to the circular that came earlier. But having said that, the riskometer is something is largely to make both the advising community as well as investing community to understand that what are the risks that is involved by looking at the riskometers, the way I think the signs are being put. I think it is very clearly now it's mentioned that low risk, medium risk, and high risk. This is further expansion of the same riskometer with respect to have a larger representation of the risk, which of course it reflects in the portfolio. When I mean what the risk, suppose we call it as a AAA securities fund, and then you end up having AA plus and below rated papers because it gives you a provision. But at the same time, while you are sticking to the offer token objective, but the risk that you are taking actually goes beyond what is being practiced as a money manager for quite some time. Then how do you reflect that? Then you have the flexibility to change the risk perception of the schemes on the basis of the risk that you add to the scheme, which of course you are doing it, money managers are doing it in the interest of the investors to enhance the return. At the same time, one should also understand what is the risk that is coming in as part of the portfolio. Therefore, you will have ability to actually adjust that. Therefore, they have now defined some rules and regulation with respect to that. So when I buy at the time of buying, I perceive this fund as the fund that takes so much of risk. Then if I make a course correction on the base of which it changes, then how I actually handle that. All such things have been defined very clearly. I think it's also coming from the fact that during the last 6 months lockdown period, is also given enough feedback, and they have taken from the industry. Therefore, whatever is coming from SEBI is more of, I would say, part and parcel of giving more and more clarity, defining more and more the parameter in which they can operate.
Yeah, no, but the larger point is, Bala, one, is it also a reflection of the fact that more and more people have seen that there were at times the risks associated with a particular category not quite put out? I'm not saying by intent, but maybe by mistake or whatever, were not quite put out. And we've had a few instances, especially on the debt side. So do you reckon that people will, let's say, the ordinary public might shy away from funds which are classified in the very high risk category?
Not necessarily, Neeraj. I think from a simple point of view, that very fact that one says openly what is the risk that is associated with every fund, whether it is a low risk fund or medium risk fund or high risk fund, and that being reflected on the base of the riskometer symbol that is being given. I think it makes the job of the investors as well as advisors much more easier to assess how much the risk should be part and parcel of the portfolio. So the way we are assigning the riskometer, even from the investor's point of view, he has to have a fund that carries a low risk. He has to also have a fund that carries a higher risk in order to generate higher return in his portfolio. As long as he knows that his risk, the return that he's getting in the portfolio is coming on the back of taking higher risk on those funds which are defined as a high risk fund. Like I just give a simple example. I think you took the name of, I think you cited the example of credit crisis. The credit fund comes with the risk associated with this a little higher than the fund that invests only in, say, AAA securities. So therefore, if we are able to highlight that, if that risk taking actually is sufficient enough to generate a better return for him, say 1 or 2% higher or maybe higher than the other funds, but any higher return, all of us should accept the fact it always comes along with the risk that one is taking on those funds. Therefore, as long as that's clearly mentioned from investor's point of view, he'll be reminded the part of the portfolio. At the same time, he knows very clearly that the risk that I am taking it on these kind of funds, therefore, I'm supposed to get extra return. And the extra return also comes along with the associated risk. These are some of the things becomes part and parcel of the communication. I think it makes it much more easier for selection to know the fact and also ensure the money managers actually walk the talk from the point of view of maintaining the true to the level kind of mandate which they are given. In this also process, there are 42 mutual funds. The 42 mutual fund probably will go to 55 and 100 and so on and so forth. There are all mutual funds will not have different definition, will have the same definition, so that if I say is a large cap fund or credit risk fund, it remains uniform as a definition across all mutual fund players. Therefore, there is no question of arbitrage between one fund house to other fund houses, purely on the basis of the definition changing from one to other.
Okay. Well, one certainly hopes. I mean, I'm sure from a investor perspective, it will be a really good means to assess whether a fund is risky. And I think maybe at that some point of time, there could be some debates as well. But because this would be clearly laid down, it should be a positive. The other question that I had, and which is, since we've in the first week of October, give us some sense of how the month of September has been as well, because quite frankly, July and August in more ways than one have thrown up a number of surprises in terms of the kind of flows that have come in, right? So has the month of September been largely equal? I mean, I don't want you to reveal something that you can't, but broadly speaking, what has been your experience at Birla?
Yeah, I think one of the trends that we are seeing, of course, after such a sharp fall in the month of March, definitely the fear factor on equity was high, and therefore a lot of people were not sure about their monthly incomes, and they're not sure about the jobs, they're not sure about how the economy will turn around, they were not sure about how the policymakers will react to the emerging trend. It did have some kind of negative impact after seeing a continuous growth for the last almost 5-6 years. But that trend in month of September is coming down. Even for us as well as a mutual fund, we have seen substantial reduction in the outflows that used to happen, say in the month of April, May, June, and probably as we move into the next few months, we will see I think the trend reversal is happening, which is the way historically it happens. My own experience always says that these kind of ups and downs we do go through, but as the market stabilizes, the equity market stabilizes, VIX comes down, and then confidence starts coming back, then naturally the flows also starts coming back. I'm just giving one simple example. I just look at the month of April, say 2021. or maybe April 2021, and then look back 1 year return. We'll look for better because March and April was very bad month. As we move forward, that moving number it gets better. At the same time, when the market is falling, your moving number for the back will always look bad. So that's the cycle in which we go through every now and then. Therefore, I think the kind of fear which was there that outflows are happening, that's again very small in relation to the overall size of the fund. But outflow, of course, is an outflow, is the reversal of the trend. But that trend, I think, in the month of September got a bit reduced.
I take it that you believe any which ways that these are apt times, or these are not mean the immediate months. I think the next few quarters or years are good times for investors to have a higher exposure to equity, because we might be in on a relative basis a lower interest rate scenario. So you expect, I mean, are you guys telling your clients and your customers and your distributors to make people understand about the benefits of investing in equity funds currently?
Yeah, I think Neeraj, is pretty interesting scenario today. In the sense, there is a disconnect between the economic growth and the stock market momentum. There's absolutely no doubt on that. I think everyone gets surprised. They start wondering how come the market is moving up so much when the economic growth is not coming. But as it always happens, that market is always it is preempted. It actually preempts some of the growth could come, and then the growth comes, and then the market gets stabilizes, and the actual growth comes. Probably you will not see the market performing. So this is the way I think the market cycle always functions. Though none of us would have expected the market to come back to a full cycle and start touching the earlier peak. But having said that, from an investor's point of view, the way I think regulation has got changed, and so much of focus has come to provide the necessary support to lift the economy as and when the lockdown gets lifted and things come back to normal, which probably would be about another 6 months away. So when you expect a V-shaped recovery in 2021, the basis of what you just mentioned about low interest rates, the focus from various governments have been in kickstarting the economy as the right time comes. So when we expect that kind of thing to happen, then naturally equity and asset class, one should start building it, or maybe continue to build an equity asset class, and not just looking at next 6 months, even beyond that. And having said that, the last the few months of uncertainty that has created, I think we must also keep in mind that gradual relaxation that is coming in is also making companies to do a little better than what they thought. I think most of the companies start measuring that coming back as a percentage of the pre-COVID level. Some companies are saying 70% of pre-COVID level come back, and some companies are saying 100% of pre-COVID levels have come back from the sales point of view, as well as from a profitability point of view. Therefore, I think one cannot actually ignore the fact that the equity asset class has to be forming with a portfolio. Also, one cannot also ignore the fact that any alternate investment that you look at building today in the form of non-equity also provides the least opportunity, given the fact the rates are low, and therefore, from investors' point of view, you have to choose between how much of the risk one can take in order to generate higher return, when the traditional investments are actually not giving so much return for me. So that's why I think diversification has to come, which is what makes me believe that the equity and asset class will come back. Having said that, it will be more coming back to the SAP form and fast track STP kind of form, rather than big time lump sum money coming in, putting money in the market.
Yeah, Bala, just one quick follow up there before I actually want to talk about the NFO that you guys have as well. But just one quick follow up. In your so many years of equity market journey, right? Have you come across a situation where the disconnect is so high, and it's okay to have the disconnect, frankly, markets don't have to be at the mercy of the economy, but that the disconnect is so high and the interest rate environment or regime, never mind the flashes, looks like it's going to be in a stable to a downward trajectory?
Yeah, I think disconnect, this is the first time I'm seeing Neeraj is on. Disconnect is really high with respect to the economic growth versus the market. I think that's coming from simple fact that if you have to draw a parallel in 2008 to 2009, it took almost about 1.5 years to 2 years for regulator to find the solution, get back on track. It took a lot of time. But this time around, the regulators have done a great job in reacting very quickly, starting in the month of March, and then kept doing many things to ensure the sentiment towards interest rates and liquidity remains high. And that's something is an action which came in about 45 days basis, which is basically April and May. They kept taking many decisions, not just in India, even globally. And that has actually completely changed the confidence of the money coming back to an equity. At the same time, I think the way I also measure the volatility index, I think this time it got settled very fast on the VIX, which also goes to show that the number of people who are taking actually a negative call in the markets have gone down quite significantly. That's also reflecting. So there's no doubt the disconnect which I'm saying. It's different from what we have seen in the past, which is of course measured on the basis of the number of months in which it remain uncertain versus this time. This time, the number of months to which it has remained uncertain is lower than what you have seen in the past. That's one big difference. I would probably say the entire comfort that has come, the way government has been reacting to the COVID situation, and the Reserve Bank of India and central banks are different from the way they used to react for the financial market crisis that we saw in 2008, 2009.
Okay. So tell us, this special situations fund that you are launching, I mean, what is this about? Because when I look at the description, it seems like it gives you the opportunity to almost buy anything that you would want. I mean, what's the reason for launching such a fund in the current times?
Yeah, I think we have been thinking about what kind of product that we can offer, given the fact that we already an established player in the mutual fund industries for the last 25 years. I think one of the opportunities that we saw, while what you say is one, this fund clearly agnostic to the market cap, no doubt. It provides an opportunity because the situation itself is special in the areas of health. If you look at, there is a big change that is coming in post these pandemic issues on the IT space. There's a big change that has come in with respect to the automations. The whole cloud sourcing model, I think, is now becoming the new way of living. And the way I think the companies were running in the past and the way I think post-COVID companies are running, definitely I think there is a serious focus that has come as to what are the steps the companies have to take in building shareholders' value. So therefore, from a money manager's point of view, we look at opportunities in this space, purely in the base of bottom-up analysis that can benefit significantly post the COVID situation. That's why I think the opportunity that we call it as special opportunities that we are calling about is on the back of that. At the same time, we have also historically seen in the past any company that goes through some tough time, run by good management, good product, good balance sheet, and very high focus on building the business for longer term. This on a sustainable model. There are many companies go through their own tough time, but suddenly you will see actually that companies coming back because the management wherewithal to stay on business on course and be successful is also remains high. Such kind of opportunities will also come in this fund. Therefore, the money manager's point of view, keep looking for opportunities in various sectors that can benefit significantly post this COVID period. Also, the companies that can benefit. The company has grown in beyond certain size. Now they need to probably look at creating multiple business model in order to generate higher shareholders value. Then look at such kind of opportunities. Therefore, we thought that during the COVID period, which of course is a special situation in general, both for the Indian economy as well as the broad economy in the world, and there are many companies who have a strong management can create a longer term value for the shareholders, given the fact that the underlying business itself is actually throwing up a greater opportunity for shareholders value to be created. And that's why we looked at this fund as a fund to be investing only on those sectors, stocks. We have not kept any bias towards large cap or mid cap. We kept it as multi cap. There's another way from money manager's point of view, when we apply a bottom-up stock picking with specific filters on those special opportunities defined, then he is free to invest in those funds, in those stocks. But again, the only principle that I kept, the portfolio would be having about 40 to 45 stocks at best case scenario, and so that we bring in a sharper focus in terms of ownership in portfolio. Therefore, we are able to create a portfolio that can generate reasonably good experience over a period of time.
But there's no market cap criteria. You could very well have 50% in large caps or 50% in small caps as well. Is that understanding?
Yes. Yeah, that's it. There's no market cap restrictions. But again, the money manager will apply the principle of large cap versus mid cap and multi cap or maybe the small cap, purely on the basis of the risk that is associated with such investments from the point of view of liquidity. The liquidity will play a role when, of course, one builds a portfolio. At the same time, the companies are able to generate, we are able to foresee that companies can generate substantially higher return, say over a period of next 3-4 years, even if it means it come from smaller mid-cap companies. Some proportion of the portfolio will go there. But at the end of the day, from a money manager's point of view, is not restrictive in nature. At the same time, they will follow some of the risk management policy, which is being defined as part of our internal risk management tool that we have created for all funds.
Bala, okay. So, well, we wish you all the best for that. It seems like an interesting fund. Let's see how it goes about. I think the NFO is open right now from 5th to about 19th or 20th of October. Bala, just one final question. Since we are on that topic of funds having that flexibility, and you spoke about it at the start, which is the criteria that SEBI got in for multi-cap funds, right? My question is, if you have such a product wherein you would have to rebalance, what would you do? I mean, because I think there is still some answers to be given with regards to whether SEBI allows funds to, change the criteria or merge it with other funds, etc. What is the likely stance gonna be at your house?
See, we as a fund house, Neeraj, we are clearly a defined parameter for every fund that we have. Right from Fund Equity, which is considered as a large cap fund, Balasubramanian Equity is a multi-cap fund. And within that, if you're on the basis of the framework that we have defined over a period of time, that how much exposure I should have in large cap, the minimum, over and above what has been defined by the regulation. So we have our own internal limits that we have set for every fund. On the basis of that, clearly, Sun Life Equity is considered currently the multi-cap fund. Currently is invested about 68% in large cap, roughly about 12% in small cap, roughly about 18% in the mid cap stocks. That is assuming that the regulation, which is now given, of course, from 1st of January, one has to rebalance it. Then suppose we continue to run as a multi-cap fund, we'll have to make a marginal tinkering in the portfolios without impacting the portfolios too much. So in our case, it will remain more or less status quo, not much will change. And if there is more clarity comes in from SEBI, we can probably take a call that which option is the best option to take. At that point of time, I think we'll play with the what comes from regulatory guidance.
Got it. Okay. Well, it was lovely chatting with you today. Thank you so much for taking the time out and speaking to us. Once again, all the best for the NFO and stay safe.
Yeah. Thank you, Neeraj, and thanks for having me part of the show. And also wish you come back from from your vacations fast.
Yeah, thank you, Bala. Thank you so much. Stay safe.
Thank you.
And thanks for joining in today. And viewers, thanks for tuning in to the Mutual Fund Show.